Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Welcome into Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services. Can you believe it? We are at the end of 2025 already. Feels like yesterday I was doing this same topic, year-end tax savings. Yes, it is inevitable that at the end of every year, our financial successes drive us to look for tax savings. We push it to the last minute. So why not do this podcast at the last minute, right? The clock is ticking. It is the 18th of December as we're recording today, but here's 5 that you could still consider for the year, and they're definitely worth considering. And some of this, I don't know if you've been keeping up to speed. We've done several sessions over the Big Beautiful Bill Act, and we actually broadcasted one of our podcasts just here recently that we had been a guest on another podcast doing. It was really good around the Big Beautiful Bill Act, and if you haven't heard that, you need to go back and listen to that because there's some things that would be potentially applicable to you and your situation, not just for year-end tax savings. Yet I digress. But that does kind of lead us into the first thing on our list for today, and that is the rules around charitable gifting. So this has not been touched in a long time. There were some changes. I remember back when I first came in the business around charitable gifting, and then those were let up. And then, charitable gifting has always been kind of one of those things that gets left alone because the government's always encouraged gifting. Well, the rules are changing next year. They're shifting. And those who are in that top tax bracket or top tax brackets actually could really take a surprise hit because there's going to be a floor. So there's going to be some of your deductions that aren't allowed. And if you're in that top tax bracket, you can't even get a full write-off on those, partial write-offs. So you could take a big surprise hit if that's what you're accustomed to and lose a significant amount of your normal deductions. So what's the planning tool here? If you're not expecting major shifts in your income from this year to next year, you may want to consider advancing those charitable gifts so you get the most tax benefit from these because those rules don't go into place until 2026. And a lot of people say, well, I'd love to do that, but there's just not this charity that I want to give money to. Well, use a donor advised fund. So a donor advised fund kind of acts as like your personal foundation. As long as you're able to turn around and send it out to a qualified charitable organization, a 501c3, and lots of things apply to that, whether it's your local fire department, your churches, your causes that you hold near and dear to your heart, locally in your community. There's a lot of things that could make sense there, but you could withhold the actual gift to those charities until when you want to make that payment. You could even set it up where it goes out monthly over time, but still make the gift and get the credit on your tax return this year. The cool thing is there's even a bonus with this strategy that has more potential tax savings. You can gift appreciated stocks or other securities to a donor advised fund. It doesn't have to be cash. And then you get the charitable deduction and you don't pay tax on the gains in those securities as well as the charitable deduction. So imagine this. Let's imagine that you were able to go in and actually pick what they call tax lots within your securities of that NVIDIA stock that's gone crazy or whatever it is. And imagine it's 100% gains. So if you were to sell that and you're in that top tax bracket, $100,000 of that stock would cost you $23,800 of federal income tax. I'm not going to talk state income tax to sell that, right? Well, if you gift those lots to the charity, that $100,000 of gains is not realized at all. So you gave them $100,000 rather than liquidating the $100,000, paying the tax, and then they get less. They're getting more. And on top of that, you still get the $100,000 tax deduction too. So and if you're in that 37% tax bracket, or maybe it's even higher because you have investment income, so it's really around 40, that's another $40,000 of tax savings plus the $23,800 of tax savings for a total of $63,800 of tax savings or more. if you're in the state levels. So that's pretty impressive. That's a huge, huge benefit to you. It's definitely worth considering. Now, here's my caveat, because I am a life planner and I'm always talking about putting your oxygen mask on first. Don't forget to replenish those funds, because a lot of times if you're taking your money out of investments, that means you're taking your money out of your long-term bucket, and that is purposed for something down the road for growth. So replace that with the cash that you would normally be giving to these charities. Just put it right back in. There's no wash rules here. You could even buy back into that same stock. So it's a pretty cool deal. All right. That's number one. Let's go into number two. The rules around itemized deductions are also changing next year. Yes, we talked about the fact that charitable gifting is changing. That is an itemized deduction, but there is a complete change around deductions in its entirety. And again, those in the top tax brackets are going to be surprised to see the hit that's coming. The good news, the silver lining, is that there are state and local income tax deductions. And I know if you've paid any attention since 2016, this is what some states have been incredibly upset about, when all your state and local tax deductions were capped at $10,000. That means if you went to pay property taxes, and I know people in Texas that pay well over $10,000 of property taxes in the major cities, major metropolitans. And so all of that was capped, that you can only deduct that $10,000. Well, SALT was increased this year, not next year, to $40,000. So that means that that 10,000 cap just grew. Now next year, there's going to be applied limitations to those caps, because again, if you're in that highest income tax bracket, they're not going to let you take it all. So if you're not expecting those major shifts in your income, just like we talked about with the charitable strategy, you might consider prepaying some of your state and local taxes this year to get the maximum benefit out of it. Pretty cool. Right? Let's say that your property taxes are normally $15,000. Could you prepay property taxes for next year and be able to get a double whammy on those? Is there other local taxes? You might be looking at you're buying a vehicle in January. Should you buy that vehicle this year? So you pay your 8.25% Texas friends in the year 2025 and get that deduction. All right. So there's the first two out of the way. I know this is like geeky stuff, isn't it? But you wouldn't be listening if you didn't want to save taxes. And everybody's looking for that last minute squeeze from the orange to get orange juice. So number three, your investments and your retirement portfolio. They provide a slew of tax savings tools for both this year and in your future. And if you really don't understand this, my suggestion to you overall is you need to put it on your priority list in 2026, that you actually get a retirement plan, a financial plan. You understand what buckets you have, and I'm talking tax buckets here, what tax buckets you have and what is their highest and best use purpose. And are you putting the money in the right place? Because a lot of people over time just dump money in their 401k their entire time that they're working. And they find out that they've got this massive tax bomb when they retire. And they retire early because I got all this money. And then when they hit Social Security age, they see their taxes go up, and then their Social Security is heavily taxed. And then they hit this thing called required minimum distribution age, where they have to even take more out of their IRAs. And that creates even more tax. And oh, by the way, that made their Medicare premiums go up. Yes, it is a tax bomb. It's like literally is like something got dropped in the ocean and the wave just went and took over. Now you have a tidal wave hitting the beach. Okay. So I say this in advance of talking about tax savings for this year, because there's a much bigger picture with this, that you need to make sure that you're doing this correctly. And I'm primarily talking about when it comes to putting money in taxable investments. That's where, like a joint account, a trust account, things like that, or putting my living trust account, or putting money in an IRA, a traditional 401k, or putting money in a Roth vehicle, which is actually going to grow potentially tax-free and come out tax-free down the road. So you've got some options here, and you want to be able to take advantage of these. So let's get to the tax savings for this year. Can you harvest any losses within your investments? Now, I know everything's been making a slew of money for a while now, especially if you've had any investment aimed towards technology and AI. However, I was looking at something, I think it was in November. Like if you took all the AI out of the market had only returned like 3% for the year. I believe that was the S&P 500. It's pretty crazy. It's really crazy. So that tells me there is a lot out there that actually may have some losses that you need to be harvesting and looking at. And if your investment advisor isn't doing that, if that's not a conversation that you're having, we always provide second opinions, of course. But more importantly, that really is, that means maybe some active management isn't occurring the way that it needs to be occurring. Your taxable portfolios, there is so much benefit to, being able to make money by saving taxes. And people overlook that all the time. Really, when you think about those portfolios, there's 3 ways to make money with your taxable investments. And number 1 is the returns themselves. Number 2 is the fees. Can I get the same return for the less amount of fees? And the number 3 thing, can I do it tax efficiently? Am I doing it tax efficiently? And if you don't have a manager that's looking at all 3 of those, again, we provide second opinions. But that's the ticket. Okay. That's number 1. Number 2, are you maxing out your retirement savings? So do you know that you may be able to, this is not for everybody, okay? This is my disclosure. You may have like hit the income limits on this, but you may be able to, okay, you may be maxing out your retirement savings. You may be able to do that plus another vehicle like an IRA or a Roth IRA. It's also a good way to tax diversify. Now, the cool thing is you actually have until April 15th of next year to contribute to the IRA or Roth IRA. But if you've got a couple of weeks left on your paycheck, make sure that you're maxing out those retirement savings if your HR company or HR department allows you to make those changes. And number 3, are you contributing to your health savings account? And I should say, are you maximizing your contributions to your health savings account? Have I told you how much I love health savings accounts? They are like really cool, really cool. Did you realize you get a tax deduction when they go in? You'll get it in there. You can actually take a portion of it and invest it for the long term, which is really cool because we all know one of the biggest expenses in retirement is healthcare, and it's becoming one of the biggest risks in retirement. And if you want to retire early under today's current environment of health insurance laws, it's definitely going to be a benefit. But those health savings accounts potentially grow tax-free like a Roth. And then if they're taken out to be used for health reasons, they are tax-free coming out on the back end. Huge benefit. There is nothing else out there, no other vehicle that you can put money into, get a tax deduction, grows tax-free and comes out tax-free. That's huge. So if you aren't using that, if you're not able to use that, make sure you're looking at your health plan. You're on the right health plan that allows for that, if at all possible, because it is a massive benefit to a retirement plan. All right. So we talked about charitable gifting. We've talked about itemized deductions. We've talked about investments in your retirement portfolio. Now, let's go to some age-old advice. It's like fine wine. Really, it's not. It's like fine wine that may be set out too long. The age-old advice when it comes to tax savings at the end of the year, buy something. That something may be a John Deere if you farm or ranch, or it might be another type of equipment if you're in another business. And yes, those limitations on being able to take those upfront tax deductions are huge, and they have grown through the Big Beautiful Bill Act. And that might be a really good piece of advice, but it might be a horrible piece of advice as well. A horrible piece of advice. I watch farmers and ranchers specifically. I'm just going to pick on you. I'm going to pick on you because I can pick on you because I come from one. We have been in those operations. We are in those operations, and I get it. We don't like paying taxes, but the worst thing we can do is eat up our profit with a depreciating asset that we don't need. Well, I bought that new truck because I got the kind of want to. I don't really need it, but I kind of got the kind of want to, and it did help on my taxes, and we justify it. But really, wouldn't it be better served if you had put that money somewhere else to grow for your future? And then you wake up when you're 50 years old and you say, I don't have anything for retirement. I've always put it back in my business or back in my ranch. Yeah, Well, first of all, if you're doing that, call us because we have a lot of other options. And unfortunately, we can't get it done between now and the end of the month. But if we start on it in January, I promise we can help be able to see some different ways that you could go about and accomplish close to the same thing, if not the same thing, and keep some cash in your pockets. So here's what you need to know when you're getting that advice, all right, is first you need to consider timing, okay? Would you need the equipment if it weren't a good tax play? Would you need it? There's a reason you get to take depreciation on equipment because equipment can lose value over time. Yes, I know y'all are all thinking about that green paint and it doesn't lose a penny of its value. And that may be true from time to time, but in generalities, I'm very serious, okay, is that equipment can lose its value over time. And you need to consider that loss of its value compared to the tax benefit. Because it really might be a wash or worse, right? Especially a vehicle. You drive a vehicle off the lot. Everybody knows this, but you don't talk about it. You drive a vehicle off the lot. What does it lose in value from day one? Well, let's suppose that you bought a $100,000 truck, okay? You buy a $100,000 truck, and that's, I hate that I'm even saying that. I mean, I think a few years ago I was saying 50,000, but, and yes, you could buy a truck for 70, 60, whatever it is, but let's just use 100 because I like even numbers. So let's say you go out, you buy a $100,000 truck, and let's say the minute you drive it off the lot, it's worth $85,000. Well, that's a $15,000 hit. So let's go to your tax return, and let's say that you're going to deduct that $100,000 all in 1 year. And let's say your tax burden is 15%. What did you gain? Nothing. Absolutely nothing. In fact, you've lost something. You've lost something because now you probably have a payment and now you've lost your cash and you've lost the ability to take that time value of money and invest it for your future. See, we don't look at it that way. We don't look at it that way because we want the here and the now, the instant gratification. I want year-end tax savings. And we ask for that. You know, I have this beef with AI that if I don't ask it the exact, it needs like perfection, a perfected question to give me the answer that I need. Okay. And I think about that this happens all the time, whether you're talking to your banker, whether you're talking to your accountant, you're telling them exactly what you need or you think you need. You aren't giving them the full picture. So you go to your accountant, you say, how do I save money this year? They say, go spend it. Was that really a good business decision? Is it really? Is it a really good decision for your future? I don't know. So another option, let's just switch gears here. Another option would be to time your income with your other ordinary expenses. Rather than spend something, maybe you could consider delaying income if you have too much this year, or vice versa. You could consider prepaying rent, taxes, or other expenses you'll need to pay no matter what. The bonus is that you can do this again next year too. It's the year-end gift that keeps giving. I always love hearing prepaid rent strategies because prepaid rent strategies allow you to get kind of like a double tax deduction this year, and you never lose it if you keep prepaying. So you actually gained a tax deduction if you think about that. That's pretty cool. So all this kind of leads up to one thing, and that's our number 5 item on here. And that is that there is great wisdom in not trying to do the job alone. So ask your tax planner, ask your accountant, ask your tax preparer, what are the opportunities they see? Make sure you're making good business decisions. But at the end of the day, they're going to know your situation better than anyone else, especially when we've only got a few days left in the year. But if you don't have a team of those people working for you, then I suggest that become a New Year's resolution. So ironically, I think this is ironic. I think this is ironic because of the character that she played. But Jennifer Aniston, we all know her as a favorite Friends star. I do miss good sitcoms. I feel like they're gone by the wayside, but maybe it's just because I grew up with that. But Jennifer Aniston, she said, when you're trying to avoid pain, it creates greater pain. And there is no truer statement for tax planning or really all of life planning. We try to avoid the pain of data gathering and pulling all this stuff together and taking a look at it, or, oh, I got to meet with my advisor, do this, because we just don't want, we know we haven't been doing the right thing. We know we need to be doing this. We know we need to be doing this, and we're just not doing it. But when we do that, it creates greater pain. When we know that we're not going to go work out, then we're going to have greater pain in the future. I promise you, if I don't go walk, my back will hurt. Which one do I want? Do I want to spend my time walking and lifting weights and exercising, or do I want my back to hurt? And this is the same principle when it comes to any kind of planning, especially your taxes. So yes, the clock is ticking on 2025, but doing nothing could create greater pain. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services out of the great town of Eastland, Texas. God bless you. Have a very Merry Christmas with your family, and be sure to call us if you need any help with your year-end tax savings or just in general, helping you live life on purpose, not by default. We love serving. It is our privilege. It is our honor. It is a God-given ability that we get to do this business every single day. It's a gift, and we would love to be able to see what we can do to help you. Join us right here next week on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.